Good morning, everyone. Thank you so much for joining us for today's free webinar, Going Beyond the Pitch Deck, a practical guide to startup funding with Peter Mansfield from Mansfield & Associates and Lori Murphy from Early Growth Financial Services. I'm Erica Malsberg. I'm the Chief Marketing Officer for Early Growth Financial Services, and I'm going to be your moderator today. This presentation should run approximately 40 minutes. If you have questions as we go along, please feel free to enter them right into the chat field or the question field, or you can even tweet them to us at EarlyGrowthFS with the hashtag #BeyondThePitch. Don't bother just raising your hand. Just please jump right in with your questions. We're going to answer them as they come up, or we might wait until the Q&A at the end to address them. And if we run out of time, we will follow up to make sure all your questions have been answered. We'll also be sending out an email tomorrow with a link to the slide deck as well as the recording, so you'll be able to review the information there. I want to start today by introducing our presenters. First of all, we're pleased to have with us today Peter Mansfield, President of Mansfield & Associates. Peter's a strategic consultant who helps fast-growth companies with all aspects of their marketing and communications, including helping entrepreneurs build relationships with investors. He's helped hundreds of startups and later-stage companies raise rounds and go through IPOs and acquisitions worth close to $5 billion. Peter was born in the UK, hence his Downtown Abbey accent, which I said wrong, Downton Abbey. I can never say that right. But he now lives in Southern California. His current clients include Billfloat, Marqeta, Pertino Networks, Revolution Credit, and Wallaby Financial. Welcome to you, Peter.
Hey, thank you very much.
And we also have with us today Lori Murphy. Lori comes to Early Growth Financial Services with more than 15 years of experience in strategic and financial roles within business, investment banking, and private equity. Currently, Lori acts as a consultant and CFO for companies in tech, media, mobile, and consumer industries. So welcome to you, Lori.
Thank you.
So before we jump right into the content, Peter, could you take a few minutes just to tell us a quick overview of Mansfield & Associates?
Yeah, sure. Yeah, I've had my business actually since the early 90s, so I've been through multiple different kind of boom and bust kind of phases as far as startup activity is concerned. And, you know, I'm particularly encouraged by what's happening at the moment. You know, but down here in Los Angeles, we've never really had as active a startup scene as we do now. So I've been running around like crazy, just helping companies build out all of their marketing functions, everything from the strategic side through to the tactical side. Just to give you a little bit of additional background, you know, in addition to sort of working as sort of a hired gun consultant, chief marketing officer for fast growth companies, I've also been the co-founder of a number of startups. So I've actually been there and pitched VCs and angels. And I can pretty safely say that I've made all the mistakes that hopefully we can help you avoid, partly through this webinar. I've actually probably made pretty much all those mistakes, sometimes all in one meeting. But, you know, I've also, you know, along the way started to build up a sort of a healthy fascination for the somewhat weird dynamics and posturing that goes on when you're pitching investors. And that was really one of the starting points for this webinar. But I just wanted to mention that rather than just sort of, you know, watching from the sidelines, I've actually been there, sitting in front of investors and been through the same rigmarole that many of you are going to be going through as well.
Wonderful. Thank you so much, Peter. And Lori, can you just take a few moments to tell a little bit about Early Growth Financial Services?
Yeah, sure. We act as an outsourced finance and accounting company where we go in and help early stage to mid-stage companies with all of their accounting, back office, tax valuations, and then also with a strategic CFO role. So we always go in with a CFO that's kind of managing the account, managing anybody working on the account, and the CFO is typically there to help the company with their, you know, financial strategy, planning, obviously help them with financial models in building out budgets, but also with kind of the decisions of, are they ready for a raise? Are they looking at debt? How do they do that? You know, what are the milestones they need to get to strategically to grow the company, and what they need to do to get there.
Great, thanks so much. So with that said, Peter, you already gave a little preview of, you know, why we are having this webinar today, but maybe you could talk a little bit more about the purpose of today's presentation.
Yeah, sure. Yeah, I've over the years I've worked on dozens and dozens of pitch decks, and I've come to the conclusion that they're enormously useful, but as much as anything, they're really useful just for internal use at the startup company, because they're a great way of sort of acting as a catalyst of really getting you to structure out your thoughts. I've become not unconvinced, but I've become less convinced that the pitch deck is really the reason why companies get funded. I think I've been in sessions where the pitch deck actually has ended up doing the opposite of what it's intended to do, which is turned off investors. And I've also sort of started to realize that the best presentations, if there is a pitch deck involved, are the ones where after 2 or 3 slides, the investors kind of call a halt and say, "We get it. We get it, and we're interested." And I've seen that happen. It's a really exciting moment. The presentation, this webinar is really about, what you can do to build up the right kind of an environment around the pitch deck, or even in some cases instead of the pitch deck, to be able to put yourself in the best possible position to raise money. So it sort of covers some of the areas like the psychology of raising capital, kind of the fundraising mindset that investors have, and that does change a little depending on market conditions and how successful their own portfolio is, but there is still a sort of a prevalent sort of mindset that we can we as startup companies and the people that work with them can kind of key off of. I think, like I was mentioning in my preamble, we'll cover some of the common mistakes that people make when they're raising money. And on the converse side, also look for ways to help you maximize the opportunities to raise money. And I think we're going to try, Laurie and I are going to try and give you some practical advice on how to prep for the meetings, what to do in the presentation and how to behave and what to do to follow up after. And then, just as importantly, I guess, looking for ways to help you close the deal. So that was sort of the goal of the session. But as far as, looking at the slide, the psychology of raising money, as far as getting into the fundraising mindset is concerned, the dominant aspect of that, I guess, is to look at your own state of mind and understand, just how confident you're feeling. Because if you're not feeling confident, it's probably a pretty good time to step back and say, okay, what can I do to at least give the impression that I am confident that my opportunity is 100% aligned with this investor. So, supporting with smoke and mirrors sometimes is a necessary sort of evil to have in your arsenal when you're going out to raise money. But I think, investors as a breed can kind of smell blood, and if you walk into a session and they don't pick up that high level of confidence, then it's probably not establishing a really good platform for you to be able to convince them that your opportunity is where they should place their money. I think as part of that as well, as far as the psychology of raising money, I've seen a lot of startups, and back in my early days of raising money, I was there myself. I would walk into a session almost with this sort of mindset where the investor was doing me a favor by granting me their time. And I started to realize that the times when I was successful or my clients were successful was when there genuinely was this sort of sense that there was a meeting of equals, and that there was sort of an exchange of equivalent values at the heart of the session. So in other words, you're granting the investor just as much a favor as they are you by you giving them your time and access to your opportunity. And I know that might seem a little far-fetched, particularly if you've been out there and met with a lot of investors and not got as far as you would hope to. But at the end of the day, if you don't have that sort of essential level of confidence that what you have is of value to that investor, it's giving you a sort of a bad start in the process of understanding the psychology of the deal. So I think it's important to sort of think through whether there is a true equivalent exchange of equivalent values. I think investors as a breed. I mean, the stereotype is sort of the alpha male, and yeah, I think that holds true in a decent number of cases. I think because of that, it does make certain, personalities, and I think, there is a certain level of gender inequality as well. I think it is tougher for women to raise money when you're out there, especially when it's sort of older white males, and I've seen that be an influencing factor. But as far as the psychology of a typical investor, at the end of the day, regardless of whether they're alpha males or not, or whether they're, what gender they are, that they are in business to go ahead and make money. And they are also in business to identify good opportunities and good startups that will allow them to do that. So, we're not going to try and play closet psychologist in going overboard in understanding the psychology of an investor, but it is good to sort of bear in mind that even though sometimes their personalities may be a little abrasive or maybe a little dismissive, that doesn't mean to say that there isn't still the opportunity there to go ahead and do business with them.
Yeah.
It's another...
I thought I'd just jump in there, especially,
Sure.
being female and completely agreeing with what Peter is saying here. And in particular, I'm speaking to women, founders and women business owners, and that is women tend to go in a little bit less confident because they're, all about showing exactly what they've done and proving it. And I think you need to walk in with an attitude of, thank you for taking the time, not being cocky. There's always a fine line, and listening to what they have to say and respecting them for what they know and their experience, but also realizing that you have great experience and you are a brilliant person who thought of this idea and is creative enough and has taken it however far you've taken it. That they want to talk to you because they want something from you too. And so I think, meeting of equals is a perfect way to put it. And also, in general with women standing up and saying, I've done this and, I'm doing well, and having that confidence, because I think a lot of it is the questioning of, should I be here or should I not be here? And for both guys and girls. But if you don't let it, upset you that you're the only girl in the room, which is typically what it is when you're pitching to an investor, you are the only female, and embrace it, and just like you'd embrace going out with other male colleagues. So.
Oh yeah, good point. Thanks.
Yeah, absolutely. Peter, shall we go on to the next slide, or did you have more to add to that one?
Yeah, no, I think the next slide is kind of looking at some common fundraising mistakes. So I'll hand it over to you, Laura.
Okay, yeah. So I think, Peter and I always, we actually chat a bit offline as well, and we'll see these mistakes, and have worked with similar clients where, you really need to understand going in, and it's still kind of coming on from understanding the psyche of the investor, but understand why they're actually talking to you. What is it that makes you interesting to them? And you may want to do that by looking into their portfolio or whatnot, which we'll get into a little bit. But know that sometimes they're going to be interested, sometimes they're not. Sometimes it just is bad timing. They might be busy. They're, doing quite a few deals, and you'll start to understand what a time-consuming process it is for the person trying to get investment, the company trying to get investment, but it's just as time-consuming, and they're doing, maybe 5 other deals for the investors. The other thing is going in with a clear objective, and knowing what that objective is. When you go in and you say, I'm raising $2 million to $10 million, even when you say I'm raising $2 million to $5 million, that's a huge range. What do you need that money for? What is that going to get you to? I mean, $3 million difference it's too big of a gap. If you go in with one amount maybe it's $3 million, and there's a ton of interest. You can always, up it from that standpoint. You can always increase it. But I think understanding exactly what you need and then understanding how you're going to get there, what are your milestones, and that does help when it comes to the financial planning and just the strategic planning of your company. If you go in and you say you want $1 million or $2 million or even 500,000, is that going to get you to launch phase? Is that going to get you to 20,000 users? Is that going to get you to 100,000 users? And make sure that the goals are achievable, because if it doesn't get you there and you don't have money at the end, the company is going to fail. So you need to really plan that out and strategically think about it and tactically think about how you're going to get there. Understanding the cash flow, I think this is just so common. When I work with companies and we're building out their financial model, there's always an issue around, we don't need to hire that many people. We just need, the three of us and a couple of engineers. And, there's, if you look at some of these great companies and you look at their bottom line, which is their EBITDA margin, most of them are not doing over 30% EBITDA. Meaning, it's just to kind of clarify, that's earnings before interest, tax, depreciation, amortization. You could even say, net profit. Most of them are not doing, 50% net profit. And you may have a unique product, but you still are going to need people. You're going to need people for business development. You're going to need people for product development. You're going to need, engineers. You're going to need somebody to manage all of the people, because a lot of the time that you take is going to end up managing people versus doing. And so make sure you plan out your expenses. Make sure you include, you're going to have to, increase rent for the people. You're going to have to buy the computers. All of these small things start to add up. And if you really are going to grow that quickly, and again, it's looking at, this part of it, overestimating future revenue. Well, if you overestimate your future revenue, it's going to show that you don't actually need the money, because you're going to grow that quickly without that many people. You should have cash flow. So they're going to say, well, why are you coming to us? So it's important to look at what that cash flow is. What are your expenses? What are realistic revenue? Growing a user base is probably easier to pitch and easier to say than growing revenue. Or, just make sure you clearly model it out. Even for the companies, I don't always say that you need a full financial model. If you're a very small company, you have a good concept, you want to just, raise a little bit of seed capital to start building. But you still need to know how far it's going to get you. And, you still need to estimate that correctly and conservatively. So I think, Peter, do you have anything to add on that?
No, I think when it comes to the number side of things, I defer to you on all fronts. So I'm much steadier ground when it comes to the psychology and the fluffier side of stuff. So as far as the next slide, which is looking for ways to lay the groundwork, I think that the starting point in this is to really kind of consider that even though it's a somewhat strange relationship, and one that most people are not that familiar with when they first start to raise money, it is still a relationship building process that you're going through. And you can almost sort of look at sort of a parallel universe of the dating scene, where if you go out on a date with someone and one of the people just spends the entire time talking about themselves, it's probably not going to be destined to be a very successful relationship. And I think if you look at sort of the relationship building process with an investor, there's a lot to be learned from that. It can't be a one-sided kind of a deal. And the best fundraising programs and processes I've been through have been ones where the entrepreneurs, the startup companies, have really spent the time to understand the investors that they're pitching. And that applies not just on the professional side, but also to take a look if they can. And some of this information is available, whether it's LinkedIn or other places, Crunchbase, whatever, in understanding the personal interests of the investor, what colleges they went to, what interests they have. Because I think, if you're going into the relationship knowing a little more about the investor, it's much more likely that you're going to be able to align yourself with investors that are on your wavelength. And secondly, when you do get the chance to meet with them, it's going to be a much smoother process of being able to break the ice and be comfortable with them. I think beyond the individual investor, the same applies also for understanding their firms. What are the investment criteria? What's the state of the funds that they have? This information is usually available, again, either through the VC's website or on AngelList or Crunchbase, or, you can dig around and use access to information like this just through the network. So it's good to know that as well going in, so that, again, you can sort of hook into the right kind of areas that are going to be meaningful for you as a business. As far as understanding the investor, whether it's an angel or a VC, it's always good to take a look at who they have in their portfolio. What other companies have they funded, and look for ways within that group to see if there's any partnership opportunities. Because I think investors usually respond very favorably to entrepreneurs and startups that come into sessions with some suggestions for ways that they can make their existing portfolio companies stronger. And it gives them, the investor, a sort of a good sort of feel for the fact that you're switched on to understanding not just who they are as an investor, but who their portfolio companies are, and it just establishes, I think, a good level of rapport. And it also shows, I think, that you're looking for more than just money, which I think is another important aspect. If you're sort of expecting the investor to whip out their checkbooks, and that's sort of the primary goal that you have walking into a session, it's probably not going to happen. On the other hand, I mean, and I'm not trying to distance the need for you to raise money from an investor, because that's one of the reasons you're there, obviously. But beyond that, if a good investor will bring a lot more to the table than just the money they invest in you as a company. They're going to have their own networks that you can be part of, whether it's their portfolio companies or other organizations they deal with. They could be, people like Early Growth. It could be people like myself. But beyond that as well, there's always the expectation and the hope that a good investor will be a very active partner in your business, helping steer you in the right direction, helping add some discipline or some oversight where it's needed, helping support you and being an advocate for you. And I think, the best relationships are the ones where that's an equal balance with the money that's invested by the VC or the angel. As far as laying the groundwork, of course, one of the other key issues is how do you get in to meet the investor in the first place? And there is a whole myriad of different ways that you can do that. You can reach out directly, and it's probably a little bit more of a long shot to do that, but certainly worthwhile. I think that the more commonly accepted and favorable way of reaching out and getting an introduction is to just work your network. And there are various ways of doing that. It could be through professional organizations. It could be through service firms that you're working with, whether it's Early Growth or myself or any other, of the types of organizations that may be helping you out. It could be through other entrepreneurs that have raised money through that VC, which is a great way of getting an introduction. But in all cases, I think it's absolutely essential that you sort of sit back for a minute and think through who may know someone else and start to work that network. LinkedIn is another resource, but again, it's coming in kind of cold. So you're probably limiting your chances of being able to get a good introduction and raise the type of interest that you're going to want to if you're doing it through LinkedIn. So wherever possible, a personal introduction is always going to win out, I think, but not exclusively so, or not to the point where you shouldn't consider every different angle. So there's kind of a relatively diverse little set of different things in laying the groundwork. But I think it's good to just kind of, again, to get into the right psychology as far as thinking through this as a relationship building process and making it again a sort of a meeting of equals where you know a little bit about the investor. You've got the tools to be able to break the ice with them by knowing more about who they are as a firm or as an investor, a VC or an angel. And then also you've got the extra ammunition of ways where you already identified where you can partner with their existing portfolio companies to make them stronger as well.
So we have a question here from Joyce, and she wants to know if you're reaching out cold, do you have any tips for making yourself more effective or getting a better outcome?
Well, I think the greatest success I've had is when you spend a bit of time looking through the portfolio companies that investor has already invested in, and at that point, once you've sort of hopefully identified one or two companies in there that seem to be synergistic with your startup, you can do a couple of things. One, you can reach out to that startup, to the CEO, to the CFO, whoever you can lay your hands on, and just get a feel for them as to whether, explain that what you're trying to do, that you like the look of the investor, that you notice that they invested in their startup, and can they give any advice on how to work with that fund. In some cases, they may say it's been a horrible experience, but in a lot of cases, they're going to say, hey, we've had a good experience, and there's no harm in asking at that point for them to make the introduction for you. They've obviously got a direct line into the firm or into the angel. So that would be one very logical approach.
I also think absolutely do that. But sometimes, I think if you have a good enough if you don't have anybody that's linked into them, I wouldn't go directly and say, I want you to invest in my company. I would go with the, would love to chat with you about this and get your insight. We're not, maybe it's even, we're not quite ready to raise money, but we just want to get some information. We just love for you to look at this because you have this portfolio company and this portfolio company, which seems like you're investing in this particular space. I'd just love to have a chat, from an advisor standpoint.
Yeah, that's a really good point. And it's almost like coming back to the dating analogy again. I mean, there aren't too many, people don't usually respond that well if you just want to jump straight into bed with someone. Maybe when I was a teenager, but, at one point, once life moves on, that's probably not the case. I mean, people just, it's much more likely that people just want to sort of step into a relationship and understand a little more in a more casual way about, what exactly benefit there is of going further into things and looking at a more formalized kind of a pitch.
And we have another question here from Jonathan. He wants to know, should you approach VCs differently than angel networks? What's the difference in approach, if there is any?
I mean, go ahead, Peter.
No, I was just going to say that there's those sort of the lines between the two have sort of got a little bit more grey because of the super angels out there, which are really sort of like VCs, and some of the smaller funds are more like angels. So it's a little greyer kind of a scenario now than it was, say, 15 years ago. But I think the overall approach is not that different. I think angels are probably looking for a sort of a broader range of different opportunities, and if you did want to sort of maybe over-categorize them, maybe a little more open to some breadth in their portfolio. But I don't think there's any hard and fast rules as to differences from a marketing standpoint, at least. Laurie, there may be some differences from a financial standpoint as well. Their expectations.
There is. I mean, angels, when you're looking for up to about 500,000, angels are fine. If you're looking for over 500,000, you're not usually going to get it from angels. So it's really, how much are you looking for? Some people say, well, I can get a little from here, a little from there. One thing is an angel will be happy, putting a little bit of money in, regardless if there's other people involved. Most VCs, if it's a small amount of money, they're not going to want to share quite, honestly, because they're looking for, 20% or more, 20 to 30 typically. but on a smaller, possibly you can get away with 20. And so with an angel, they might be looking, they might be fine with 5%. They might be okay with 10%. It's not, that they don't need 30% because they're getting in early. They're getting at probably a lower valuation than a VC would have. In terms of approaching, same tactics. Find somebody that knows somebody. And, going into the next slide, setting goals, we'll chat a little bit more about that. But really it's, if you reach out directly, sometimes you can get in there. Always, don't reach out and just say, hey, I need investment. Reach out and try to build some kind of rapport with them. So I think it'd be quite similar, actually.
Great, thanks.
Erica?
Yep, thank you. We can move on. We have some other questions, but let's jump back in, and I'll sprinkle questions throughout.
Okay. Shall we move on then to kind of setting goals? And then in the next slide, which, I do want to kind of touch on exactly, always going back to the previous slide when, Peter said personal and professional understanding the investor and figuring out what school they went to and what hobbies and that kind of stuff makes a big difference. So one of my goals when I go into a meeting is to develop an instant rapport. And, people will say, well, they've only scheduled, so there's a couple of goals. So usually a VC anyway. Sometimes an angel will give you an hour, but usually a VC will schedule 30 minutes. That's it. That's all you get. They tell you, look, we don't have any more time. It's only 30 minutes. Almost every VC meeting that I've gone into, if the client really has everything together, the company, it goes to an hour. So use that first 5-10 minutes to build a rapport. And one of your goals coming out of there are two goals. One would be, find common interest, build some common rapport so that they're comfortable with you right off the bat. The other thing is try to make it an hour meeting if you can. If you don't get through everything, and I'm not saying, you do have to be very concise, but if you don't get through everything because they continue to ask good questions, not questions like, where's your competitive slide, because you need to have a competitive slide before you walk in there. But if they're digging in deeper, just, answer as concisely as possible, maybe talk about it a little bit more, whatever they want, but know that your next goal will be getting a follow-up meeting. Those are, have that in mind when you go in. Don't think that you're going to walk away with the cash, but try to build that, that relationship, as Peter has been saying. The other thing about getting into a VC, there have been a number of funds that are, very early seed stage kind of popping up. These guys have been with the larger VCs, a lot of them, previously. And so if you go in and pitch somebody, even if you're not right for them, if they like your pitch and if they like you, the investors know other investors. Have one of your goals be to get, introductions to other investors possibly, if that's appropriate for that person that you're meeting. So, make sure you know what your goals are when you go into the meeting. And then obviously the other goals are, how much money you need, which we've kind of already talked about. Make sure you're also very prepared when you go in for the questions. So it's great to have dry runs, and have them with people that are not going to be nice. You don't want to run a dry run pass unless you can get in front of somebody, even if it's just a friend or an advisor, that's going to be cynical, that's going to ask you the tough questions. They're going to ask you, how many users are you going to get to, and how are you going to get those users? What's your acquisition strategy? What is their money going to buy? How are you going to build up past that? Any kind of barriers, they're always going to ask you about competition. The worst thing you can say is, I have no competition. Everybody has competition. Figure out what your competition is. If you have a brand new product in a brand new industry, figure out what your closest competition is. Figure out what people were doing before. You know, if there is a problem and a hole in a market, that's fine, but figure out the closest thing that matches that hole. So, you know exactly what their questions are going to be, and then know why, again, the research ahead of time, what their portfolio is, why you're going to fit into that portfolio. They do enterprise software, so they've done, you know, a number of enterprise software deals. Look how recent the deals are, because if the deals are way in the past, maybe they're not doing them anymore. You know, if they're doing mobile apps, see which apps they have, see if it's competitive or complementary. Again, know how much you need, and who should go to the meeting. I get asked this all the time, and really, the team, the founding team, it's great to bring the founding team to the meeting. If you're 5 people, you probably don't want to bring the founding team. If you're 3 people, it might be a good idea to bring all 3 of them. If there's, you know, I think going one-on-one is sometimes very difficult, because it looks like you're just a person with an idea. Having at least 2, I think, is a good number. 3 is a good number. If you get to 4 or 5, it's probably a little bit too much. The CEO should always go. Somebody who can explain the technology part of it, whether that's the CEO or the CTO, is good to have. You know, those are probably the primary people. And hopefully one of those people is somewhat of a salesperson too. So that's pretty much, you know, when you're looking at what do you do before the meeting, make sure you plan that out.
Yeah, I totally agree with Laurie. I think just having one person in the session is from the startup side, it makes it very difficult. It doesn't seem like there's enough going on there somehow to go ahead and build credibility. So I think it's important if you have, you know, multiple co-founders to at least have 2 or 3 of you in the session, and, you know, helps you be able to understand the dynamics a little better as well.
Absolutely.
So carrying on through to how to actually behave during the meeting. So we're back on the psychology side of things here again now, and I think there's a lot of interesting sort of things that are easy to see from the sidelines, not so easy always to be able to follow through on when you're actually in the heat of the battle and you're actually presenting to an investor. But some of the things that I've noticed that a lot of entrepreneurs or startup folks or co-founders will do when they're pitching to investors is they'll hide behind their laptop. And, you know, it just builds an automatic barrier up there. And I think it's good if you can to, you know, think through some of the basics of sort of body language, you know, and not only your own body language, but pick up on the signs that the investors are making with their body language. You know, the classic kind of leaning in and more collaborative kind of a feel to the session is obviously a positive sign. And you can help sponsor that kind of a process by making sure you do it yourself. If you're leaning back in your chair and it seems like you're disengaged, it's probably going to encourage the investor to do the same thing. So it's always good, I think, to sort of think through the body language and make sure that you know, you're leaning in and you're actively sort of getting as close as you can to the investor, and that you're also looking them straight in the eye, and you know, being as positive and as friendly and as happy, smiley as possible without being over the top. So again, part of this comes back to the confidence factor that Laurie mentioned, and making sure that you know, when you're on top of your game, you are going to probably be more control of or you'll be certainly you're presenting a more positive body language issue side of things as well. If you can, sit on the same side of the table. If it's a large conference table, particularly at a VC, that's always a good thing, because I think, again, it starts to establish this notion of a collaborative kind of relationship, as opposed to you in there pitching to the investor. So, you know, if you can sit on the same side, that's not always easy, because, you know, often you'll be shown into the conference room and you'll be kept waiting there for 10, 15 minutes. You know, at that point, you know, some investors will sort of use that as part of the posturing process of sort of more or less insisting or present, you know, getting into a spot where they're sitting on an opposite side of the table. But if you can break that down, then make it, you know, try for it. As far as things that you should emphasize when you're actually there sitting down and you're into the flow of things, I think it's good to always obviously go ahead and explain clearly what your solution is and why you're so excited about it. Explain a little bit about the origins of the solution, and that might be where the pitch deck helps out, or it could be, if you're confident enough to not use the pitch deck, you just kind of walk them through that and give them the elevator pitch and a little beyond that. I think it's then really good to go ahead right up front, because in a lot of cases, an investor is going to make a judgment call within the first 5 or 10 minutes. So early on in the process, I would look for ways where you can present the investor with some initial endorsements of what you're doing. In other words, third-party people of some shape or size that have gone ahead and looked at what you've got and have gone ahead and said they like it. And that could be customers, it could be prospective customers, it could be other investors, it could be analysts, or it could be partners. But any kind of, or it could be media. If you've already got coverage on TechCrunch, or you've already, been featured in a blog somewhere, I think it's really important that you go ahead and give the investor the sense that they're not just stepping into the dark here, that other people have looked at this and given an endorsement. Now, of course, you don't want to make it seem like they're late to the party, but I do think a good investor is going to look for those kind of points of endorsement to give themselves a little more confidence that they want to press ahead with you. So I would definitely look to emphasize some endorsements. I think it's good to also mention the kinds of partnerships that you're looking to build alongside, the product that you're developing or the solution that you're developing, because I think, again, you're only ever going to be as good as the customer acquisition processes and programs that you have in place. And I think it's, a lot of the time, the key partnerships that you can mention with intermediaries or channel partners or other companies that are going to go ahead and endorse and recommend your product are just another good way of getting over the fact that you've got endorsements for the approach that you're taking with your solution, and that also that you've got a channel developing that's going to make it easier for you to acquire customers. So definitely emphasize, the partnerships that you've got that are starting to come together. And then I would also look to emphasize the fact that you are building the company around a very agile framework, so that you're testing and refining your solution constantly, because I think that shows a degree of flexibility and a degree of market and optimization and opportunism that a good investor is going to want to see. Sometimes they at the core of that, they're still going to want to know that you've got a focus, but I think it's good to emphasize that you have got a very very dynamic approach to making sure that you're responding to what you're hearing about the solution. As far as questions to ask, I think it's always good to ask them if they've got initial feedback, and you can do that very early in the session. Do they understand what you have? Do they have any suggestions for how, for how you can take your solution to the next level? I think I wouldn't be shy about asking if there's any other partners at their firm or any other angels that they think would either have relevant domain experience for your solution, or people that they think that they could bring into the mix as well. And if you feel things are going well, don't be frightened to ask them what the process is for exploring things further with their firm or with that angel. And as Laurie mentioned, ask for referrals. Even if they may not be interested, and a variety of reasons why it may be too early if it's for a VC fund, ask them for referrals into angels that they like to work with, that they think would be interested in this. So those are all good questions to ask, I think. So that was it. And I'm trying to keep an eye on the time here, and I think the next slide is actually covering after the meeting, and I'll hand things back over to Laurie.
Okay, yeah, I'll go ahead and kind of take it through. So after the meeting, how long do you wait before you follow up? Honestly, it's like a job interview. Send an email and say thank you. I would always do that. I'd probably honestly, as Peter mentioned, what's the process? Is your final question. So when they tell you that process, make sure you have that in the calendar of, if they're going to get back to you, what their process is, and make sure you put it in your calendar so you're following up accordingly. Don't send 10,000 emails to them. It will only annoy them. It will not show that you are eager, or it'll show that you're eager, but kind of like psychotic eager. So you don't want to inundate them, but at the same time, you do want them to know that you are very interested in them because of X, Y, and Z. You feel like it's a good fit because they have this certain expertise. We said before at the beginning of this call is be confident, but at the same time, you do have to kind of feed their ego a little bit, and it's. I'm sure they if they've given you good advice, take that advice. Tell them thank you for it. If you're impressed with something that they've done, tell them that you're impressed. So I think when you're following up, it's fine to say that. You want to respect, again, their experience as well. In terms of how to follow up with the VC portfolio companies, I think that it's important to get an introduction from them. And I think that that's also a great way to follow up with a VC. Is, you talked about, X, Y, and Z company, and it would be great to get an introduction. Make sure when you do meet with them, be careful of what you say if you didn't like the VC, or if you're, I've heard a lot of startups, like to complain, oh, they're, egotistical, or they don't understand, they give you lots of questions. Definitely don't do that with a portfolio company. And I would try to avoid that in all cases anyway. As I said, you do need to respect that they've seen a lot of companies, which is one of the reasons that you want a VC on your firm, because they have seen a lot of companies. They've seen what works and what doesn't. So, maybe they're right, maybe they're wrong, but, at least give them some respect there. Referral follow-up, again, same thing. Always good to make sure you get the introduction. And, how to read the signs of what the investor's intentions are. I always ask. I'm a pretty direct person. And I think at the end of the meeting, say, what do you think? Are you interested? Where do you think the holes lie? What do you think is unique about us? What, and that also allows them to, to actually express it and think about it in their mind, and you can then answer any of their questions right off the bat of, well, maybe there's, this missing part, and you can kind of answer that. And then stay in touch. I mean, if you guys aren't right now, and they're always, working their network, stay in touch, give them updates. If it doesn't work out in a couple of months, you get a press release, send it on. They're always appreciative to hear about it, and it may be that they're interested later on. Like I said, they might be working on 5 different transactions at once, and maybe they just don't have the time, and in a couple of months they do. So I would definitely stay on. And then how do you close the deal? So, sometimes I've also seen where companies come out of a meeting and they're just so psyched because the meeting went well, the chemistry was there, they loved the investor had great questions, which is all good, except for the investors, it doesn't mean that they're going to invest. Pitching is, 10, 20% of it. You have to actually close the deal. And if you say a bunch of stuff or leave out a bunch of stuff in a meeting, you are for sure going to kill the deal when they start digging in, because they'll figure it out. If you've had a lawsuit, tell them. I mean, maybe not tell them there, but if they ask, tell them. If it's something big, tell them. Don't, it's not that you want to hurt yourself before you get a chance to get started, but just make sure that you don't leave out, facts. I did private equity, and I was looking at a deal where we loved the deal. It was a guy who was, it wasn't in tech, it was actually in kind of a consumer goods, and he had built this business, and it was doing great. And he first failed to tell us that he had gone through a bankruptcy, and it had been 5 years, and there was good reason, but the fact that he failed to tell us was a huge deal. We got over it because we really liked him. But then he failed to tell us that he was actually being sued by the partner of the other business. And we just walked away. And it was because we had our investors to answer to. And, from a, ethical standpoint and from an integrity standpoint, we couldn't invest in him because he twice did not tell us something. And so we had to walk away. If you fail to be completely transparent, the investor will walk away. The diligence process is longer than most people think it will be. I've seen deals close in a very short time because it's a brand new company and the concept is new, and maybe you can close it in 2 to 3 months. That's rare. If the company is over a year old, it's more likely that it'll close in 4 to 6 months. And, they will dive in and they will look at every single contract you have. They will look at all of the financials. They will ask for additional schedules of financials. They will ask for, contracts with vendors. They will do a background check on each owner and each manager of the company. They will look at all of your HR contracts. It's not a simple process. So, possibly it is possible to close in a couple of months. If you have an angel investor that's going to stick money in, it's very possible, but you do have to go through some processes. You do typically have to have a budget, and you will have to go through the documentation process as well. So, make sure that you're aware of that going in, and make sure moving on, know what to expect from the investors once you close it, because you're pretty much marrying them, and they will have rights, and you want to make sure that you're comfortable with them and you're comfortable with how they do business. So I think that's really, to summarize, it's again, it's not just a pitch deck. It is developing the relationship. It's how you're acting, what your attitude is, that gets you in front of them and gets them interested. And they will follow up on everything that they see when you first meet them. So no, you just have to take that from the beginning and carry it all the way through. I think that's about it.
Peter, do you have any closing thoughts before I jump into some of the questions we have here?
No, I'm given the time. I think probably be good if we can just leave a few minutes for Q&A.
Okay, sure. So we have a wide range of questions here, so we'll see what we can get through. So first we have John was wondering if you can provide some guidelines on cost to raising capital. He's talking about if you perhaps hire a consultant or someone to help you with the process, and he wants to know if you have information about fees, commissions, what that might cost. Or
I could definitely jump in there.
Okay.
Yeah, so I'm a previous investment banker and still my license, and still do a little bit on mergers and acquisitions and sometimes private capital raise. So, typically there is a retainer fee if you're working with an investment banker. If you want to hire an investment banker, it's, they can sometimes break it out into monthly fees, or it might be a straight retainer of $50,000. Up to $500,000, depending on how big. But typically for a smaller company, it's a smaller retainer fee. And then it's also a percentage of the raise. So that can be anywhere. If you're doing a merger and acquisition on an exit, it's going to be a lower, maybe 2%. However, if you're doing, raise, it can be anywhere from 5% to 10% of your raise. So if you are doing an earlier round, typically you would not hire an investment banker, and quite honestly, an investment banker would not want to be hired because you can't pay them enough to do it, because it's a lot of work. There are other people that will help you. Peter is one, I am one, where you might be paying on an hourly rate with early growth, and we'll help you get prepared, help you with your financial model. Typically we'll work with outside parties like Peter on the pitch, but at the same time, at least with me, I actually sit in and go over the pitches with my client and work on their pitches as well. and then they do their dry runs with me. And that's on an hourly rate that we charge, which is $200 an hour for the CFO. And then on the fee side, I think, Peter, you can probably say what your typical fees are, but I think it also depends on the client, and it depends on how much work is necessary.
No, I mean, I think as far as on the looking at the process of putting together the pitch deck and sort of helping clients get ready from more from a marketing and communication standpoint and a strategic standpoint. Typically, folks like myself, we work on a retainer. Sometimes that's split between sort of cash and equity. It seems like a lot of the sort of higher gun folks like me seem to be around the same sort of price point, sort of low thousands of dollars a month. And like I say, sometimes that's cash, sometimes it's equity, usually it's a mix. There are people out there that just do pitch decks, and I've seen them as low as sort of $1,000, $1,500. When you're at that level, dollar-wise, it's typically more sort of a visual approach, just sprucing up a pitch deck and making it look nice. You're probably not going to get a lot of strategic guidance at that level. There's other firms out there that will charge $10,000 or $15,000 and come in and do a much more kind of comprehensive job on putting a pitch deck together that will be much more a lot more strategic advice on how to position your startup, how to look at the areas of opportunity, and present good visuals that are going to support your competitive situation and that kind of thing. I'd be happy to sort of answer you a little more specifically, via email or on a call after, if anyone wanted to get a more specific sense for what the typical fees are.
Great, thanks. You can all see that there's some contact information up here, so if you have outstanding questions, feel free to follow up directly with Peter or Lori for assistance. But I think we have time for maybe one or two more questions here. So one is, sorry, I'm looking through. Another John wants to know, what experience do you have with matchmaker sites like Funding Posts? Do you have anything to say about those where you get set up with an investor?
I think from my standpoint, there are a lot of those. You're in a pool with a lot of competition, quite honestly. I know very few people that have actually got funding that way, but I do know a few. It's harder. I mean, we're talking about building a relationship, which I think is a better way to go. And knowing the investor, I think with that, you are going in completely cold. They don't know you from Adam, and I wouldn't say don't do it, because there's always a possibility, but I think the chances are slimmer. And sometimes it works, sometimes it doesn't. I think if you look at it and they start sending you, it's always it's additional avenues. So I wouldn't completely put them down, but then you're still going to have to take it a step further and develop that relationship and make sure that it's somebody that you want to invest. I mean, remember, yeah, maybe you need money, but you're marrying the investor. So just you'll have to dig into that aspect as well.
Yeah, and I would say that the only thing that I had to add to that was that it seems like, sites like Funding Post and some of the other sort of matchmaking sites for fundraising are more relevant earlier in the process. So if you're at the seed round, it's probably a better bet to take a look at least. But, as you get further into it and you're talking millions of dollars being raised, then you're back down to sort of the classic approach, I think, in most instances of going out and meeting with firms that are going to give you some money, but also add a lot of additional value. And it's less likely you're going to be able to find someone like that online.
Yeah. Okay, great. And we have a few more questions here, but what we're going to do, just to be mindful of everyone's time, is if you asked a question and we did not answer it, you will receive a follow-up email. In addition, all of you will be receiving an email tomorrow that's going to contain the deck and this recording, so you can reference back to that. And you see the contact information here for Peter and Lori, so do feel free to reach out to them with additional follow-up questions. So on that note, I just wanted to thank you all so much for joining us for today's webinar. We really appreciate your time and hope you found this to be useful. If you have any follow-up questions, You can also tweet them to us, but there's lots of ways to get in touch with us, so go for it. Our next webinar is October 1st, which is on mistakes to avoid when starting up, and that's going to be presented by Early Growth Financial Services and SBL Council. You can visit our events page to register for this event, and you can also check out all our upcoming events on our events page as well. So thank you so much, Peter and Lori. This was a fantastic presentation, and have a great day.
Hey, thank you all
Thank
so
you.
much.
Bye.
Bye.